It's time for the Money Puzzle Podcast. With good conversations and realistic solutions to the money puzzles we all face every day. I'm your host, financial advisor, chartered financial consultant, and president of Edgen Insurance and Financial, Robert Edgen. Now let's get this show started. Hi there, hello, and welcome to the show. I am Robert Edgen, and I'll be your guide for the ride for the next 10 to 15 minutes. Each week, we look at a different piece of your money puzzle and practical ways to deal with it so you can have the financial confidence you deserve and the future that you dream of. This is episode number 4, and today we're talking about timing the markets. Does putting your money in the stock market and taking it out at the right times have an impact on your financial future? And if so, how much of an impact does it have? I'm super excited about today's conversation, but before we get into that, let me say hello to my amigo, my pal, my business partner all the way down from Denver, Brian Johnson.
Hey, Rob.
Thanks for driving down again. Appreciate you spending some time with us. Everything okay with the drive down? So far, so good?
Spring break week. Couldn't be better.
Spring break week. Correct me if I'm wrong. You're taking a vacation for the rest of this week.
For a couple days.
You're going to go skiing with the family.
Skiing.
Awesome. That's what we do here in Colorado when it's spring break. Honestly, I avoid the ski slopes during spring break and try to do all my skiing on the other weeks because all of the wonderful tourists who visit our state are taking up all of the parking spaces. They're filling up the lines. They're doing those things. But we're at different stages in our life.
Yes, 4 kids at home still.
4 kids at home, 2 kids out of the house. That's right. Different timing. So, all right. Glad to have you here today. I'm super excited to get into our topic of the day. But before we do, let's take a look at some news. Every week, I do a lot of reading and research, and I came across a financial news story that, Brian, I wanted to share with you. Get your opinion on it. So let me read you this news story real quick. This is out of NBC News, and it says, the headline is, Florida man sentenced to 40 years for plotting to bomb Target stores to disrupt the stock prices. Mark Charles Barnett, age 50, out of Ocala, Florida, or Ocala, Florida,
whatever,
was convicted in July on federal charges of attempted arson, possession of an unregistered destructive device, and making unregistered destructive devices. He offered a person $10,000 to place bombs hidden in food packages in Targets throughout Florida, Virginia, and New York. And his theory was that the stores would get such bad press and they would take a hit in sales because no one would want to go there. Stock prices would plummet and he would buy in at the bottom and ride it up to the top.
You know, it wasn't really a theory. I think they did that in a movie about 13 years ago, from a James Bond movie.
He was stealing someone else's idea.
Yeah, he was. So in the James Bond movie, they tried to blow up a prototype, brand new like a new Boeing, as an example, airplane. They're going to blow it up and plummet the stock, and the guy was selling short.
Stock prices go down, then you buy in, you ride it all up. So today we're talking about timing the market. It sounds like what this guy was trying to do was to create the market.
Create the timing.
Right? He was trying to create the timing. Timing the market is hard. Creating the markets is, well, it should be impossible, especially if you're having to do criminal activities such as putting bombs in Target stores.
Blowing up a Target.
And, I mean, fortunately, they found the guy. He's behind bars. So, I mean, it did not go his way. But not only is he not intelligent for all of the reasons that come to mind, but if you actually stop and think about it, this guy could have taken advantage of the declines as well, right? He could have shorted the stock, rode it on the way down, and then bought in at the lows and rode it on the way up.
Sure, absolutely. Why not? I mean, isn't that what day trading is all about?
Well, so I guess if you're going to break the law and risk going to prison and spending the rest of your life behind bars, at least take advantage of both rides on the stock market.
Yeah, why not? Short it and long it.
Short, that's right. Do it both ways. So, all right. So, our advice today is do not try to create the markets, especially through criminal activities. Let's get into our main topic for the day. All right, so Brian, last time we got together, we talked about time in the markets. We talked about giving your money time to grow and to compound, and how compound interest is the 8th wonder of the world. And today we're going to talk about the opposite side of that, or the opposite side of the coin, timing the markets. So Brian, tell me, what does timing the markets mean to you?
Well, what it means to me and what it means to somebody out on the street is totally different. The way that I think about it, timing the market is when do we purchase? Well, when we purchase is when we get paid, right?
Okay.
When most people have 401ks. So what do? You get your paycheck, you have a certain percentage of your 401k or a dollar amount going in to the 401k. That's what I consider timing the market. A lot of people out on the street consider timing the market as trying to pick the exact time to buy and the exact time to sell, whatever stock they're looking at.
So that way they miss out on the big lows and they capture the big highs. That's the idea behind it.
The idea, the theory, yeah, that's what they try to do.
According to Investopedia, they say market timing is the act of moving in and out of the market or switching between asset classes based on using predictive methods such as technical indicators or economic data. I mean, it sounds confusing, but they're describing it as getting in or out of the markets or changing asset classes. What are some of the common asset classes that people invest in or maybe switch between?
Sure. Well, most of the time we think about asset classes as global. So anywhere in the world, Europe, Asia, it doesn't matter where, South America, United States. Then you've got your growth, your core, your value, bonds, and cash. What most people do when they're trying to time the market, they're trading individual stocks.
Individual stocks, okay, because they're thinking that they can time it accordingly to, with that particular asset class or maybe a different asset classes.
Right.
But what I'm hearing you say is that asset classes are not the same as college classes. This is not Psychology 101 or things like that.
It could be mathematics.
So, okay. All right. That's the only college class. Got it. All right. So Investopedia goes on to say, because it is extremely difficult to predict the future direction of the stock market, investors who try to time the market tend to underperform investors who remain invested. Do you think this is true? And if so, why?
It is. And it's actually pretty clear because what takes place when you're trading your own money, when people do that, what ends up happening is you have a lot of emotion that gets involved in it. It's like, please don't let me make the wrong mistake. And so there's a lot of what ifs that you end up asking yourself. So, oh, geez, what if it goes down more? What if I miss the increase and it's already at the top? What if I pay too much for this? Or there's just too many questions to answer when you're dealing with it on yourself, and all the emotion makes you make a bad decision.
Well, and even Investopedia says this is really hard.
It is.
So hard that most people who try to do it underperform the market. And I have a study that, and I'll link all of this stuff to the show notes, but I have a study that says that individual investors tend to trail the stock market by 2 to 4.5% every single year. So the stock market just doing whatever it is going to do, the individual investors trying to pick are not only losing to the stock market, but they're being outperformed by 2 to 4.5% per year.
Right. That's right. So you always have to let's look at the big recession. What took place there? Most people when they sold their own investments, they did not sell when the stock market was at 14,000. If you remember what that was, they didn't sell there. Then the market started going down, and they figured, it'll come back. It'll come back. It'll come back. And then finally they had enough. When they had enough is when the market gets to that bottom of the V, when they start really narrowing it down. Everybody sells off. We hit the bottom, and then it starts coming back up. And then by that time, you're thinking that it's going to go back down. It's going to go back down. I made a big mistake. It's going to go back down. And you never get back in until everybody is feeling good. And then you decide to buy again.
So they tend to buy low and sell high.
No,
they tend to buy high and sell low. That's right.
That's right.
That's right. That's absolutely true. There's a lot of emotional things that happen when you are trying to time the markets. If you are trying to time the markets, a lot of times what happens is you miss out on what are considered the best days of the year for the stock market.
That's right.
And typically there are a handful of days in a year that really make huge impacts on an overall investment portfolio's return. They call call these, catching the best days. And then on the flip side, there are days that are worse than others. These are, and you would like to miss the worst days. But it's very difficult to do. But I do want to talk about what happens if you miss out on the best days of the market. I saw an interesting study by Putnam just a few days ago, and they looked at the past 15 years from 2003 through the end of 2018. Okay. And they found out that if you missed just the top 10 days in those 15 years, it affected your portfolio. Now, I'm not giving you this answer. I'm putting you on the spot here. But if you missed out on the top 10 days in the last 15 years, how much did your portfolio miss out on?
Oh, I'm going to say 5%.
50%.
50%.
50%. So by trying to time the market and missing out on just 10 days in 15 years, your portfolio would have been, in theory, $1 million. Now it's 500,000.
Well, yeah, I think we can go back and take a look at what happened in December of 2018. Right, we had a huge correction, 20% or whatever it was at the time, and then what happened in the first 3 months of this year. It all back up. So if you got out in December and you're feeling bad, and then things start working its way back up and you're not so sure on what's going to happen, you just missed out on that recovery. And possibly if you stopped your 401k contribution, your IRA contribution, you missed out on those returns as well.
You missed out on perhaps already the 10 best days of 2019. We don't know. And that's just it. It sounds very simple. Make sure you've got your money invested during the 10 best days. You could almost skip the rest of the year if you're invested for the 10 best days, which sounds simple because everyone knows you should buy low and sell high, which is easy to do when you're looking backwards, right? I mean, hindsight's 20/20.
It is, but it's also when you talk about buying low and selling high, but you have to look at your age as well, right? If you're 30 years old, what's your time horizon on that? What do you want that money to do for you? And if it is retirement, you're 30, that's 35, 40 years down the road. So we're not even looking at that point of even selling high. We're just trying to come up with a game plan, create that financial plan, and invest on a systematic basis.
Yeah, but what gets in the way a lot of times, I find with my clients, is that emotional side that you were talking about. It's the behavioral economics. And behavioral economics, really has a lot to do with biology and science and emotion that basically says, we as people, there's all of these millenniums of human nature that is hardwiring us to make these bad decisions.
Right.
We have to that's something that we have to fight against as individuals. And that's one of the reasons that people who tend to work with an advisor will do better than those who don't. Maybe it's not even because their advisor is making the right picks, but it's he or she is helping them with that emotional side of things.
Basically talking people off the ledge. So when you think about that and you're taking a look at it, if you have two investors, you had one that the return was straight up, and you had the other one with all the volatility going on like crazy, but still ended at the same end point. Who's happier? Well, basically, it's the one that went straight up. Well, what was the difference between the two investors? Absolutely nothing. You had one that looked at it looked at her annual statement, and you have the other one who looked at it every single day. So what did she see? She saw it go straight up, and what did the other person see? Saw it zigzagging around, and oftentimes if you're watching that zigzag, you're going to get out of the market.
The stock market and investments, it seems like that's the only thing that people don't want to buy when it's on sale.
Right.
They always want to buy it and watch it go up. Well, what happens when it goes down? That's maybe a better time to buy, but that's not normally what happens.
Yeah, I did have that conversation with a client not too long ago, and I just asked him, I said, so when do you go shopping? If you need a new suit, as an example, do you go when there's no sales, or do you wait until the day after when it goes on sale and you actually go? Well, of course, his answer was, well, I'm going to wait to the sale before I make that decision. Okay,
sure.
Great. Well, we need to do the same thing with the stock market. the S&P 500 index or buying an individual stock, do we buy it at the high point? Not necessarily, unless we have a systematic plan to do so, and it's part of the actual financial plan to go out and buy that stock right now because of what their expectations for revenues are into the future. But when we have a dip of 500 points, or like we had back in December of 2018, where it's down 20%, that is the time to buy. We just have to, as individuals, think, you know what? I'm going to buy that suit when it's on sale, not when it's not on the clearance rack.
Right. And that happens a lot in the investment world because it's that fear of loss. What if it's not done going down? What if it goes down and I lose all of my money? So that is definitely a part of it. And I have found it not only impacts individual investors, this is a human thing. Yeah. It impacts professional investors and hedge fund managers. I know there was a very famous challenge that Warren Buffett issued to the hedge fund world in 2008. And he said, look, I'm going to challenge you, $1 million bet. And the loser pays $1 million to a charity that says, Warren Buffett said, I don't think any individual hedge fund manager can beat the stock market, right? A decade later, at the end of, or in 2018, what had happened? Not a single hedge fund manager had beaten the stock market. Now, the stock market, we're talking about the S&P 500, and there's probably lots of reasons why they didn't, but I'm thinking a big part of that has to be with still the same thing, trying to time the markets and missing out on the big days.
Yeah, again, I don't know exactly what all those hedge fund managers were doing, what assets they were using, but you still have human emotion involved in making those decisions. Where the Index 500, there's no emotion there at all. It just does what it does.
Yeah.
And again, in that 10-year period, what if we had that major recession that everybody was talking about in 2018? If we would have had that, maybe Warren Buffett would have lost.
Maybe, but he didn't.
Don't know.
Yes, but he didn't. So and I'll have the link to that in the show notes, that study. The end result was that the stock market over a 10-year period did about 85.4%. Yep. The hedge funds averaged 22%. That's not per year. That's over the entire decade.
Right.
So not only did the stock market win, it crushed the individual investors. And it just goes back to the same thing that we're saying. Even these people who are paid millions or hundreds of millions of dollars, they're still dealing with timing the markets and emotional things and that sort of, those issues that can complicate it. So, Brian, what is the bottom line? Can you effectively time the markets with your money?
No, it is absolutely impossible to do that. If you have your brother Joe out there day trading, he's always going to be a winner, just like everybody I know that goes to the casinos always wins, right? But yet the big resorts have the biggest buildings in the country.
That's right.
But everybody who goes always wins.
That's what they say.
That's what they say.
Yeah.
Now, you cannot time the market and expect to outperform. It just is not going to happen.
I would suggest, if it's something that you want to try, because I love money experiments, if it's something that you want to try, peel off a small portion of your investment account or your retirement account that hey, this is my experimental money. This is a different little side bucket. It's not going to have a major impact on your financial confidence or the future that you dream of if it doesn't go as planned. But then see how you do over a 1, 3, 5, 7-year period. Beating the stock market for a few months might be luck, and beating it for a year might be luck. Can you consistently do it? If not, you're just like the majority of the world. If you can, well, you might be a genius. Real quick, let's take a question from the mailbag. All right, today's question is from Kim right here in Colorado Springs. Kim says, my brother has been getting into investing and he keeps telling me I should be taking advantage of dollar cost averaging. What is it, and should I listen to my brother? Brian, can you quickly explain dollar cost averaging?
Dollar cost averaging is simple, systematic investing, having it come out of your paycheck, either weekly, however you get paid, and have it invested immediately. That's dollar cost averaging, and your brother's right.
Well, your brother's right. Something we don't I don't ever tell my brother he's right. So, but I tell my brother, his brother's right all the time.
Right.
Yes. Dollar cost averaging. The other thing that it does when you're consistently buying every single month, twice a month, let's say out of your paycheck, they subtract money, put it into your 401k. Yep. Sometimes you're buying things when they're higher priced because stock markets are going up and down, but sometimes you're buying them at lower prices. So it helps you with that buying things when they're on sale, even if maybe you don't emotionally want to because it's happening automatically, correct?
Yeah, absolutely.
Yeah, okay. All right, well, that's about all the time we've got for the show. We're going to wrap things up. But if you have an insurance or a financial question that you'd like to get the answer to, email us at questions@yourmoneypuzzle.com. That's it for today, Brian. As always, I appreciate you coming down, spending some time with me. I hope that you'll join us, and please don't keep us a secret. If you got any value out of today's show, if you enjoyed it, please share it with someone else who might be able to implement it in their life. And until next week, be safe, have a little bit of fun, and go out there and do something to improve your money puzzle. You'll be glad you did. We'll talk to you real soon.
Registered representative of and securities offered through Securities Management and Research, Inc., SM&R. Member FINRA SIPC. Investment advisory services offered through BFC Planning, Inc. Hedge and Insurance and Financial Services, Johnson Financial Services, SM&R, American National Family of Companies, and BFC Planning are independent entities. There are risks involved with investing which may include market fluctuation and possible loss of principal value. Particular investments may not be suitable for certain situations. Carefully consider the risks and possible consequences involved prior to making an investment decision. Our firm does not provide legal or tax advice. Be sure to consult with your own legal and tax advisors before taking any action that may have tax implications.